Hi and good evening. It's Monday, 18th of June 2018. Welcome to the premiere. First time at Admiral Markets with Jens Klatt. Trade the markets profitably with Admiral Markets, the Open Range Breakout by Jens Klatt, professional trader and analyst. Welcome, my name is Jens. I'm just the introducer, and let's have a nice start. Like with every webinar from Admiral Markets, we will start with our risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk because it's level products. If you're a starter, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and your personal risk management. If you'd like to read the full risk disclaimer, or maybe to read the key information documents, the kits, please visit one of our web pages, for example, admiralmarkets.com, and you will find everything written down there. And of course, if you like to trade Forex and CFDs, you will get many benefits only with us. For example, one of our bestseller, DAX 30 CFD, triple split of just 0.8 points during the main trading hours. Check all the details out on admiralmarkets.com. There will find also something about our regulatory background and how to contact us. You can call us, you can send us email, or visit the other channels like YouTube or Facebook. Everything's linked, of course, on admiralmarkets.com. So enough from my side. Time for Jens Klatt. Welcome to the premiere. Good evening. Hi. Now it's your time, Jens. Welcome, and let's have a nice start.
Yes, hello also from my end. So let me just show my screen. 1 second, please. So you should now probably see the first slide, but I'll do it that way. It's probably a little better. 1 second. So now you see the chart here, the S&P 500. Already you can see that I've prepared something. Nevertheless, before we start and probably have a look at how the setup would have performed today, I will present to you. And I also can tell you that this setup, which I will present here, is not only a setup which is one of my favorite setups in general when trading the markets, especially from an intraday perspective, but that we'll stress test it here next Wednesday on the 20th of June 2018 at 3 p.m. London time. So you can already register for this event, I think, on the webpage from Admiral Markets. So feel free to do so. And yeah, so before we head here into the price action from today, and we'll have a look here at how the setup would have performed today, I want to introduce it to you, and therefore, there we go. It's in fact a 3-step intraday trading strategy for the S&P 500. So there are 2 things I'd like to say here. Jens was so kind to already mention it regarding the offering in the DAX, but not only the DAX, but also the Dow Jones here, which therefore, let's have a look here, which is offered from Admiral. So the featured products are covering the Dow Jones and the DAX. So it's not only the DAX with the typical spread here of 0.8 points, but it's also the Dow Jones 30 with the typical spread of 1 point, which is, I consider it to be highly competitive compared to other brokers. Probably the most competitive offer in the market here. And now some of you might probably wonder, why do we focus on the S&P 500? If in this case, obviously, we're focusing on the US market opening, so why don't we look at the Dow Jones here? And the reason for that is quite simple. When I started trading the markets, that was more than 10 years ago, so it's 2018, probably like 12, 14 years ago. My mentor back then was trading the S&P 500, and I started trading the S&P 500 back then, and that was the reason why I focused on the S&P 500, and I never changed this. So yeah, and so that's the main reason for it. Even though, and that's something which is probably very interesting for you, this setup I will present to you here, it wasn't me who invented it. It was in fact introduced, not even invented by Toby Crable himself, but it was introduced from Toby Crable in the 1980s. And in fact, very, very interesting. I'd like to share here something else, a slide which I haven't, in fact, which I haven't prepared here, we have the chance to find an external web page, external source here. It's from CTA Performance, and what they usually do is, or not just usually, but they track the performance of hedge funds, respectively, so-called commodity trading advisors. That's CTA in this case. And Krabel himself is not only an analyst, but a trader and a highly successful hedge fund manager, managing north of 1 billion asset under management he's currently trading, and his performance can be found here. So currently in 2018, for example, you can track it here. It's updated on a monthly basis. He's doing quite well. I mean, with a 8.7% performance so far. And here are also some performance statistics back to March 1998 till May 2018. So we're talking about 20 years. Max drawdown was here 16%. While the max loss here was obviously during September 2001. What happened there was this tragedy with the World Trade Center. Probably he was long the S&P for whatever reason. With one approach, didn't get stopped out until the trading stopped there, and then come back into the market several days later with a significant gap down. But it's only speculative, and it. Let's put it a little bluntly, it didn't kill him, so he still performed really well. And why do I show you that? It's very simple. It emphasizes that this strategy, which stood the test of time here for over 30 years now, was introduced by a highly successful trader. And even though some of you might now say, hey, this looks very, very rough, and it really, no one can really imagine that this is a profitable approach, in fact is. And it's not only on the S&P 500, but you can adopt it to the Dow Jones, you can adopt it to the DAX, for example, you can adopt it to Asian market hours here, especially the so-called Asia range breakout that's on the FX markets. You can trade it in treasury markets like the Bund future, and it's really applicable to many markets, in fact, and very, very easy, nevertheless highly successful and effective trading strategy, which is really, really profitable if approached the right way. And what I'd also like to emphasize at the end of this webinar, you will see it's very important to have mental, stable fundament your trading is built on, because the hit rate of the strategy is around 50%, slightly less than that. So that means that you're more than often on the wrong side of the market, and obviously the approach needs a very stable risk and money management. You're running it with it. So yeah, so let me just now give you those 3 steps you're running through. By the way, I talked about 2 things I'd like to emphasize here. First of all, let me give you those 3 steps, and then give you the second interesting aspect here of this 3-step intraday strategy here, trading strategy. So first of all, what we need to do is we need to define an open range. By the way, that's right. That's wrong. 1 second, please. GMT is not correct. We need to change that. It's CET. It's Central European time. So right now, due to the fact that we are talking about summer time, we're talking about 2 hours here. So it must be CET. So what you know is that at 3:30 p.m. CET every day, the Wall Street comes into the market and is starting trading. And obviously, we're talking about a trading strategy which only covers those 7 hours? No, it's 6.5 hours, from 3:30 till 10 p.m. CET then, and it's an intraday trading strategy. So we define the open range. What is an open range? It means that during this time span, 3:30 till 4:15, we're looking at the high and the low of the market. That's it. So we are looking where's the high of this time span and where's the low of this time span, and this is what we'll define as the so-called open range. And then we identify an advantage. Identifying an advantage in trading in general, when it comes to trading strategies, is crucial, because it's a fact that trading is a zero-sum game, and somebody wins, somebody loses. And who are the winners? Who are the losers? The winners are usually those who are trading with an advantage, meaning those who are knowing that the long run, if they keep on repeating this, in this case, strategy, that they'll come out ahead in their trading. So in fact, when it comes to trading, respectively, to risk and money management terms, we're talking about something which is called, they are coming out with a positive expected value. There's also something, probably you need to be a little careful. Nevertheless, I think it's a perfect way to put it. If you're trading, that's something you should always remind yourself of. If you're trading, try to trade like a casino. That's a common saying, in fact, among traders. So what's meant by this? So just imagine we're going to a casino playing some roulette, and we're saying, okay, let's bet 10 euros on black, and then the is it the concierge? No, the dealer, whoever, he runs the ball then, and it's black, and you are making 10 euros. So are you now a profitable roulette player? Well, in fact, you're not. And what's more important, the casino really does not care about your 10 euro gain, respectively the 10 euros they lost. So what they make sure is that the long run, they'll come out ahead. They have a positive expected value. Why is that in roulette the case? Well, there's the zero, this green field, which is giving you, once you're betting on black or on red, giving you an advantage which is below 50%, while the payout is 1-to-1. So that means if you now use the formula here, which is called expected value, which I will introduce to you a little later, that means that you come out with a negative expected value and that you're losing money. That's in fact it. And this is the same which is true for traders. So what you need is you have to have a trading strategy which gives you a clear advantage. You need to identify this advantage first, and then you need to make sure that after all, you're having a positive expected value, respectively, that your risk and money management plan makes sure that you stay in the game of trading long enough to capitalize on this advantage here. And what we do is we identify this advantage here based on the 15-minute exponential moving average, the EMA 10. And then what you do, or no, first of all, let's have a look here. What does this mean? It means nothing more than if the S&P 500 trades above the EMA 10 here on a 50-minute time frame, we only go long. We trade breaks out of this defined open range on the upside, while if it trades below, we are going only short. So meaning there could be occasions once the market, for example, during European trading hours, pushed extremely in one direction, the S&P is opening here, in this case at 3:30 p.m., and then defining an open range between 3:30 till 4:15, from which the S&P breaks out on the downside, while nevertheless trading above the 15-minute exponential moving average 10. So that means we have no trade in this moment because we are trading above here this identify, or this advantage identifier, and as long as we trade above that, we are only going long. So that means if we're breaking out on the downside, and you might say, well, now we go short. No, we don't go short, since we are not trading, as here said, below this EMA 10 in this case. So, and then the third step, it's we trade the break of the open range. So somehow I've already taken this now ahead of this third point. So it's we trade the break of the open range in direction of this identified advantage, and we put the stop above, respectively below, the high-low of the range. What I usually don't do, but in this case, for example, it's probably important to mention this, since I will show you, some of you probably will start shaking their heads right now, saying, I can't believe that this is profitable and will work out. It does, it still does, and we are trend followers, in this case as traders, so we trade the trend till it bends. That was something which was mentioned from Ed Seykota and Market Wizards already at the beginning of the 90s. That was this interview series which was run by Jack Schwager. or the trend is your friend. We expect this trend of profitability to continue here in the past. But the thing is, what we want to make sure is, or what I want to avoid is to really give you too much and give you not enough room to develop your own trading approach. That's one of the reasons why I, in this case, do not mention or did not mention where to exit the trade. So the backtest I will show to you a little later is that we'll say 10 minutes before the end of the spot market happens. That's again 10 p.m. CET, that's Central European time, German time in this case. So 10 minutes before that, that's 9:50 p.m. CET. We take out the trade. It doesn't matter where it trades, and if it did not reach the stop level, which we put in here at this step. Okay, so now I've talked a lot, and some of you probably want to see an example of that. And in fact, I've prepared an example. So therefore, have a look here, and in fact, you can see it here. It's an example which, or the screenshot was taken here at the 13th of May in this case. So it's nearly 2.5 to 3 weeks ago. But also here, it's only to understand what we went through here. Next step will be, I'll show you how this setup here performed today, respectively still performing. That's something we have to add here, since again, we take out the trade if it's not stopped out before, and so far it isn't. We take out the trade at 9:50 p.m. CET, and then the next step will be on Wednesday, we'll trade the this setup here. And that's also a nice anecdote I want to share with you, but this is later. So first of all, what did I do here? So far, nothing special. In fact, what I did is I identified this open range as in step 1 described between 3:30 till 4:15 p.m. CET. So these are those thin black lines. I hope you can see them here. And then what I did was I said, okay, and now we have the blue line here, which is showing us the EMA 10. This is the exponential moving average. In this case, on a 50-minute time frame, you can see it here, and it's the S&P 500. So yeah, and what happens here is that if you really closely watch this candle, you can see that even though this is a red candle, we're trading still with the close above this blue line. And this is key here in this fact, because it means that now we are going long with this big green candle once the market here breaks above this upper thin black line in this case. So we trade above the EMA 10, breakout on the upside of the range, so we are going long. And that's in fact it. The stop was placed here below this low of this range. So we are not focusing on a Dow theory stop or something like that. No, we have the range and we break out on the upside, so the stop is placed below this range. That's it. So, and then we're taking out the trade. So it's a 50-minute time frame here. Obviously, there are several 50-minute candles for each hour. In fact, 4. And so here you can see that we exit the trade at 2,724.25 at 9:50 p.m. CET in this case. And obviously gaining a profit since we went long at 2,709 with the stop here slightly or close to 2,701. So it's around 8 points risk, while we gained a profit of 15 pips on this trade. And yeah, obviously it makes the most sense to show you a trade which worked out. Nevertheless, what I can tell you is that a backtest over a very, very long time span will show you that you're wrong in around 50% of the cases here. But this is the next step. So this is the picture now, the example. Let's have a look now at the MetaTrader here from Admiral. And therefore, I've already prepared here, obviously, the range. You can see it here. These are those thin red lines. And you can see here, that's in fact not that perfect, because I think it makes the most sense to probably short this a little to here, because then you can clearly see when the breakout occurs. So what you can see here is that obviously this range, by the way, I've already prepared this here. the editor. So the SPX 500 open range today can be found between 2,756.7 to 2,764.6. So it's a range of 7.9. I'm sorry, 7.9 points here in this case. And now the question is, okay, we have identified the range. Where do we trade in relation to this blue line, which is the exponential moving average 10 here on a 50-minute time frame? Obviously, you can see it's a close call, but we are here trading slightly above it. So in fact, we're trading within the range. And what now happens, that's probably something worth mentioning here. What happens is the moment the range is defined, which is here, this candle. So let me just do, oh, wait, 1 second. We have to really zoom into the chart here. So what you can see is that we are slightly trading below this blue line, if you carefully watch it. And this means that the first order, which was given here, was a short order because we traded below this blue line. I mean, obviously, we do not have a strong trending market here, and so it's more a coincidence than anything else. But the thing is, we're slightly trading below that. That means the initial order, the first order, you would have given into the market as a short order. The next candle, the situation switches. So first of all, we are obviously breaking out here on the long side, which this is a signal we do not take. Why? Because we still have to wait till this candle is closed. That's the first thing. And second, the first order was a short order. We traded in the candle before slightly below this blue line. That means we are not trading the market long here with this breakout happening. But, and this is the thing, once this candle closes, we are again switching the market conditions because now we are slightly trading above this blue line. This is something you can see here. So now we're only trading the long side because we say, okay, obviously, we're now trading, the identified advantage should be found on the long side. And, well, we're trading above that. So it's the long side. So now the interesting thing is you might wonder, okay, does that mean now that we adopt this open range to this high in this case? So slightly higher because we've already seen higher highs here, or a slightly higher high? No. We, in fact, do not change anything, but we stay with this open range, which was defined between 3:30 till 4:15 p.m. That's it. We don't change it. And now, well, we're with the next candle breaking out here. In this case, breaking out on the upside. And so far, the trade is showing a profit. So the breakout occurred here at 2,764. As here, 0.6 in this case, and currently we are trading at 767.6.7. So meaning we're still ahead 3 points, and so in fact nothing changes. So just imagine we went long here on this signal. We just stay into the trade, and it's a make or break it trade. That means we are staying in this position till tonight, 9:50 p.m. CET, Central European Time, German time in this case. We stay with the trade and we'll just see what will happen. If the market continues to move on the upside, or, well, in fact, it doesn't, what would be a pity, let's say, because it would mean that we are not facing a winning trade then in our P&L at the end of the trading day. But all in all, yeah, that's also part of the game in this case. There's another approach, by the way, which sometimes can be used. Let's come back here, and that's, by the way, a great chance then already to introduce to you this great tool here, this mini terminal, which by the way, clients can download from the Admiral website here and have access to as a client forever. So there's no expiration date. And if you're a demo client, you have access to this for 30 days, and then it expires. By the way, one good reason to probably think about opening an account with Admiral, but just saying that, because this tool here, in fact, this price letter, as I learned today, and in fact, I haven't seen it before, and I was just wondering why Admiral has this, because they have some exclusivity to it, I think, at least for another month until other brokers are allowed to offer this. But that's just saying. So let's come back here now to another setup, probably also based on what would have happened. Just imagine the following, and therefore let me just do the following. I just work here with that in a very, very rough way now. Work with this here with snipping tool. So just imagine the close of this candle here once this breakout occurred while we didn't take it because we still had our short order placed in the markets. Just imagine that probably here the close of this candle would have been there. So there's something interesting happening now. We are obviously breaking out of the open range here on the upside, not taking the short signal. Now the next candle opens above this exponential moving average 10 on a 50-minute time frame. But obviously we are trading also above this thin red line here, which is showing the high of the open range. So what happens? Well, it's in fact it's very easy. What happens? The system switches now to long, while we are obviously finding the advantage here based on this approach on the long side, and it places a limit order, which can be done by this price ladder, for example. So you can here click into this, and now click into it and have. Did it work so far? I hope so. So it's okay. I'm sorry. We have to wait a little. That's probably a little too much for the resources of my system here. Okay, let me do it once again. So what you can do is you can click into it and then go down. I hope just it works. It doesn't. I'm sorry, really. That has
you have to stay in the area of the bar. So if you want to make a stop or take profit trade, just move the mouse, but be
perfect. The bar. Now there we go. Yes, it's perfect. Thank you very much. Yes. So now you can see how to use this tool. It's really cool. To be honest, for traders, short-term traders, we're not only trading automated, but probably from time to time trade from a discretionary perspective. This is just awesome. That's just great. And as you can see here, you just are capable of placing this order with only one mouse click here and then move lower. And by the way, also what you could do, even though we won't do it now because it's against the rules of the system, we are not placing any limits on the upside because we take the trade out manually here. Something else I'd like to mention here is, as you have seen here probably, there you can see that you're capable of placing a risk here. 1 second. Let me just delete this again. I'll probably, yeah, that way. So we place it here, and now the cool thing is you can already see it here, by the way. You're risking here a euro amount, which, by the way, can also be changed here, but this is something we go through a little later on, or probably on Wednesday. That's a little better because I'm still not done. I want to present to you the backtest, remember. But the great thing is that you can here predefine how many lots you plan to trade. You can predefine your overall risk you are willing to take. For example, you're trading a 10,000 euro account, you're willing to take 1% risk per trade, that equals to 100 euros. You can predefine that here, and obviously trade in a very quick manner here in the environment of the MetaTrader. So in fact, really cool tool, and in fact, perfectly also to illustrate here how to work with this trading approach. In this case, how to probably trade with such a setup here. In fact, we now work with a limit order. By the way, that's something I have to show to you. But imagine the following: we're still trading within the range. Then in this case, you have to place a so-called buy stop order, or in case of a short position, sell stop order. The great thing is if you do this here above the highs, you can see there's here on the left. I can't move the mouse through this, but you can see there's a buy stop, while if you trade below that, it switches to buy limit order. That's also something you can obviously do by using this price ladder here in this case. So yeah, but this is also an approach you could use in case of the market then breaking out of the range and then trading above in this case, our advantage identifier, which is the EMA 10, while also trading above the range. And you want to place a limit order here in this case, and something you can achieve here, easily achieve, in fact, with this price ladder. So now let's come back to the presentation. Let's have a look here. Again, first example, screenshot. Second example today. Third example and stress test will be on Wednesday. Remember that? Now let's have a look here at the back test. There's a story I'd like to tell you behind this, because you will be surprised to see the following graphic here, because obviously it is not a MetaTrader backtest which was run here. The story, the anecdote behind this screenshot is the following. I was giving a presentation with someone else, also a professional trader here, and one with a very quantitative approach. Several months ago, somewhere, yeah, obviously July, must have been during July, and what I wanted to present to the audience was a backtest here for this approach, but the problem was we had a lack of historic data, so it was only available for something like 1.5 years. And this other professional trader with this very quantitative approach said, well, let me give you some help here. I can run this backtest for minimum 7 years because I have data back till that date, somewhere in 2010, in this case, November. And now you might wonder, why did I take this screenshot? Well, in fact, it happened that during this webinar, the other presenter had some, or the moderator had some trouble with his internet connection here. Lost the internet connection already several times before he presented this backtest result. And for my strategy in this case, respectively, I presented it. And so what I did was I took a screenshot before that, and in fact, 10 seconds later, the connection was interrupted again, and he had really trouble to re-log into this webinar. Nevertheless, I was capable of taking over because I had the screenshot, and I never changed this because I all the time want to present this small anecdote here and how it comes that we have this. So 2 reasons, obviously. First of all, more data available, and the second is this anecdote with the internet connection interruption there. So what do I show you here is the backtest result, and you can already see, obviously, there it's saying EMA 10. This is the only highlighted area, let's say, in this case. So it's the advantage identifier we're working with here, so the exponential moving average 10. And we are working with those input parameters I just presented to you. Looking at the open range, 3:30 p.m. CET till 4:15 p.m. CET. We're saying trade above the exponential moving average 10 on a 50-minute time frame. We go long if we get to see a breakout on the upside. We go short if we get to see a break on the downside and trading below the EMA 10 here. And we take out the trade. 2 chances. First is we get stopped out, or we take out the trade manually here at 9:50 p.m. CET every day. And those are the parameters. And this is the equity curve this backtest creates here. And some of you probably are a little irritated here on those small numbers here, which I'd like to present to you here then via some lines from my end. So the result is the following. First of all, we have the number of trades. The number of trades can be found here. There, it's 1,347 trades which were made during this time span. So then we have here the win rate. This is the hit rate, which is obviously, as already said, 47%. Obviously, the loss rate then must be 53%. And some other very important numbers we have here. It's the average gain and the average loss. So the average gain can be found here. It's 1.06, and the average loss can be found slightly below that. It's 0.82. So it's slight minus before that, but we will ignore that here in this case. The minus comes into play a little later. So why do I take out these numbers here? Why do I do that? I can explain this in a very, very easy formula. I've already introduced it. We are talking about the expected value. And here we have the hit rate. You multiply it with the average gain. And then we subtract the loss rate multiplied, loss rate multiplied with the average loss. So, and now we can easily put in those numbers here. In fact, I will do the following, by the way. Make it a little easier. There's another number which traders refer to as the so-called payoff ratio. Payoff ratio is defined as the average gain divided by the average loss, and can obviously be calculated then by dividing 1.06 through 0.82, and you'll get no, just 1 second here, calculator. It's 1.29 to 1. Okay, so now we can do the following. We can use this number, 1.29, fill it in here, and then just only multiplying the loss rate in this case here with 1, which makes things a little easier. So now let's calculate this. It's the expected value. We say it's 1.29. We multiplied in this case with our hit rate of 47%. This equals to 0.42. And then we subtract 1 multiplied with our loss rate. Here it's 53%. And now what do we get is 1.29 multiplied with 0.47. It's 0.66, and we subtract 53 here, because 1 multiplied with 53, 0.53 equals to that. And obviously you get a result which is positive. So we could round it up to 8 cents. We will do, in fact, because now we have to formulate a final sentence here on what we just calculated. And what did we just calculate? It's in fact, how much can we expect to gain for every euro, USD, British pound, Japanese yen, Swiss franc, whatever, how much we can expect to gain per each euro in our case we risk. So this means that here in this case, we can expect for every euro we risk to gain 0.08 cents. Some of you now probably might say, that's not very attractive, right? Isn't there a saying which says we have to at least aim for trades where we gain twice as much as we initially risk? Yes, that's completely right. But here we are not looking at the so-called risk-reward ratio, what you're referring to, but we are looking at the expected value. So in fact, here in case of the expected value, it doesn't matter if we're winning or losing. This makes things much easier. Look at it from a mental perspective. Very interesting. Look at it from this perspective, because now you're trading this setup and you really look forward to trade it, and you really do not care whether you're winning or losing because you know you're winning. This is like we trade like a casino. That was what I initially mentioned when I said this. So we know that we're winning, and we're really happy to see as many people in our casino as possible who are looking at the a game of roulette here and betting whatever amount. I think, in fact, the higher the better for us as a casino, because we know even if some of them might walk out of the casino with, like, say, a gain of 10,000 euros, at the end of the week, they will return and play again. And over the long time span, over a long period of time, we will make money and get back our 1,000 plus even more than that. And this is exactly what we look for when we're trading. I mean, I know that it's very, very difficult and always, it's in fact difficult to talk about like casinos and gambling, but in fact, I don't think it's gambling when you look at it from a perspective of an expected value. And if you're trading, playing with a positive expected value, because then we start to talk about running a business here. And this is exactly what a casino does, if you want. And this is the same how we should approach our trading in this case. We should look at our trading as a business in this case and try to only do those bets where we have such a positive expected value. And in fact, this is exactly what you can see here in this case. So meaning, if you're making on average 8 cents per every euro you risk, that means nothing more than, let's come back to the 10,000 euro account I was talking about. Let's imagine you're risking 1%, that's 100 euros. You multiply those 100 euros here with those 8 cents, meaning you're making on average 8 euros per trade. It doesn't matter if it's a winning trade or if it's a losing trade. But in this case here, if you can stabilize, this is the thing now. I mean, some might say, well, these numbers are from the past, so you have to really stabilize those numbers and continue to average those numbers here to make sure that you're really making, in this case, 8 cents per every euro you're risking. That's 100% true. Nevertheless, I can tell you that based on my personal trading and the trading results I'm getting, these numbers are in fact very, very likely to be achieved in the past, in the future too here, because around 8 cents per euro risk on those breakout strategies, this is something you can really expect to happen then. I mean, it depends on how you change those input parameters, but all in all, you can see that this is one of the, in fact, one of the most profitable trading strategies. The only thing you need is time, and then things will usually play out for themselves. What you need is, not just patience, but you also need a plan on how much you risk per trade. This is especially true. Just imagine the following. We have a hit rate here of 47%. Now, let's round this up to 50%. And imagine the following. If you have 10,000 euro account and you're betting 5,000 euros, so half of your account in one trade, you could have come out ahead, yes, but if you come out below, no, not below, if you come out on the wrong side, you're obviously losing 5,000 euros. So the target you as a trader have in this case then is, after you have found such a profitable trading strategy, it's not a trading strategy. It's not only to have the mental stability to trade this over and over again, but it's also and especially important to make sure that you give yourself a chance to be caught on the wrong side. And this is something many traders really forget, let's say. Some of them, I mentioned, I met plenty of very good traders, really good analysts, but many of them failed due to the fact that they did not give themselves the room to fail, to be on the wrong side of the trade. And this is something where now many of you probably start to understand why risk and money management is so important in successful trading here in this case. So now, let's sum this up again. If you want, I invite you here to take a screenshot of this and the definition of the open range breakout setup. So we went through this several times, and again, just screenshot this and or contact, in this case, Admiral Markets. I can easily give out the presentation, so it's no secret or something. In fact. However, just screenshot it, write an email to Admiral, whatever. I'd like to share some final thoughts, because some of you probably now come to this conclusion. Cool. Well, it's very easy to just duplicate the strategy, and well, we just have to trade it and make money trading the markets. So the thing is, I really want to emphasize this. Please don't do that, because now the thing is, there's another very simple trading approach. It's called the turtle trading approach. Some of you might have heard about this. It's an approach which wasn't invented but traded by the turtle traders. Those traders, which William Eckert and Richard Dennis wanted to educate and make professional traders. They went on a business trip to Singapore somewhere in the 70s, I think, and saw people raising turtles, and they came to the conclusion, or they wondered, is it possible to to raise profitability in trading, or to raise profitable traders. And that's why it's referred to the turtle trading experiment. So an interesting thing is that many of these traders who were what's the word for this? I'm missing it. Not invent, but however, the traders who they wanted to teach trading here, in this case, many of them, in fact, around 90% failed. So they never made it, even though the trading approach was very easy. This is the point where mental stability comes into play. And that's one of the reasons why I really highly recommend not to just copy paste this. But how can you use this then? I mean, some of you now wonder, hey, okay, great, I shouldn't copy paste it, but what's the sense of this webinar then? There are two things. So first, I recommend to use this presented strategy as a basic strategy and fine-tune it based on your personal preferences. That not only includes the time frame, but it also includes the traded assets. Again, I said it at the beginning, the S&P is not necessarily the main traded asset, but it's more like to be the Dow Jones, or also the DAX. Some of you might focus on FX pairs, but the breakout approach and the idea behind this stays the same. It's only a question of fine-tuning it for your personal trading personality. The second is, and this is something I wanted to refer at the beginning, now it took until the end, you have to have such a clear plan. And I'm a big friend or a big fan of having such a clear plan. So in fact, over the years in trading here, and during experiencing many coming to me and wanted to trade the markets, to make long thing short, thing is that those who were really creative, and it's fascinating, the creativity of these people. Sometimes it's just like, wow, you just think about them as geniuses, and really, you really think about this. Nevertheless, they fail in trading because the creativity is something which is bringing them under trouble under such circumstances in the market, because they now say, well, shall I go long? Well, we could interpret it like this, and here's this and that pattern, and now let's analyze it from this perspective, probably should go short. And the problem with this creativity then becomes obvious. You do not trade, or even if you identified your setup and have identified your clear advantage, you're not trading it. On the other hand, those which have a clear plan they follow, like a pilot, for example, running through a list before he starts the engine of the airplane and then flies you from, let's say, Berlin to New York or something. There's a clear plan he follows. And many of these people, pilots especially, they are successful traders because they are used to follow this clear plan. And so what you could do then is to use this basic strategy to formulate such a plan for you. You go through then every day over and over again. And you can then document your trading, and you can start to improve your trading. Therefore, probably it's better to show you this last slide here. It's a documentation, or it's an example of how such a plan could look like. You start to trade, for example, make 20 demo trades with this suggested setup here, and you write down the result in your trading journal. So you write it down. Not only let it document, in this case, the MetaTrader, for example, it documents it for you, but you write it down yourself. Then you review it and you analyze it. You calculate, for example, the hit-loss rate of those 20 trades, or the payoff ratio. Remember what we just went through here with this editor. We filter out the areas which are causing underperformance. So, for example, you might find out that you did not take this or that signal because you didn't feel comfortable doing that. And in the end, it turned out that the trade would have been a winner, which turned your whole experiment of those 20 demo trades, for example, a winning experience, while not taking the stop loss here because you thought the market will turn around or something, caused a loss which exceeded the anticipated loss you were willing to take, making this, again, unprofitable. And then you start to improve here. So you ask questions like, how can you get rid of the identified mistakes, for example? Finding a clear plan of really taking the losses and finding out what do you need to do to take the loss as you predefined it, for example. You then try to implement the change, and you repeat. You start it over again and make again with the implemented changes 20 demo trades. And that way you start to follow a clear, straight plan in your trading, which will hopefully improve your overall trading experience. Yes, and so in fact, that's it from my end. So the last slide is this one here. It's thank you for your attention. It was a pleasure to be here, and I'll be here again on Wednesday, again at 3 p.m. UK. So London time in this case. We will focus on the US market opening, and we will stress test this strategy here then with the real market opening of the S&P 500. And yeah, so that's it from my end. Thank you very much, and thank you, Jens, for letting me be the presenter today.
Yeah, thank you also to Jens. So we both have the first name Jens, but the last name is different. So I am Jens Schonowski, and that was Jens Klatt. Thank you to Jens Klatt. Tomorrow is another day. If you'd like to join more of our webinars, join Real-Time Daily Trend Ideas. We have 5 days a week, 5 different traders all the time to the same time, quick and smart. If you'd like to join, just do it. Visit admiralmarkets.com or the other web pages you will find in our webinar section. We will see and hear Jens again, if you like, on our YouTube channel a couple of hours later. This webinar will be there as a recorded video file, or in 2 days, like he said, on June the 20th, 1 o'clock Central European time, if you'd like to join. All is free from us. And for now, have a nice day, have a nice evening. Thank you, and bye-bye.